Live price action and intraday dynamics. Right now, as we watch the tape on this Thursday, November 20, 2025, Applied Digital Corp., ticker symbol APLD, is changing hands at exactly $22.88 per share. We are seeing a minor contraction in today's session, with the stock down approximately $0.20, translating to a decline of roughly 0.89% on the day. While the broader NASDAQ composite is fighting for direction, APLD is seeing a consolidation phase, hovering just under that psychological $23 level. The volume is ticking over steadily, not quite at a breakout pace, but certainly active enough to show that the bulls and bears are wrestling for control of the narrative here. If you are watching this on your Fidelity mobile app, or tracking it through Interactive Brokers trading charts, you will notice that the stock opened slightly higher but faced immediate resistance, pushing it down into this red territory. This isn't a crash, it is a breather. But to understand why a sub 1% drop matters, you have to look at the velocity of the money that has moved into this name over the last few months. The stock is sitting on a powder keg of expectations, and today's slight pullback might just be the fuse burning down. Expectation versus reality, the infrastructure trap. Here is where things get interesting, and this is the angle most mainstream financial news outlets are missing today. The general expectation, the street view you might hear if you are browsing investing sites or chatting in a Robinhood stock trading forum, is that Applied Digital is a high beta proxy for the AI boom. The assumption is that as long as NVIDIA and the hyperscalers are spending, APLD will go up, and when they pause, APLD will crash. Investors see it as a speculative play, a former crypto miner trying to dress itself up in the flashy clothes of high-performance computing. That is the expectation. The reality, however, is significantly more nuanced and, frankly, more bullish for the long-term holder who understands credit markets. The reality is that Applied Digital is no longer just a speculative equity story. It is rapidly becoming a credit story. With the recent pricing of that massive $2.35 billion senior secured note offering we saw earlier this month, the company has effectively graduated from scrappy startup to capital-intensive utility. The market is treating today's price action like a tech stock fluctuation, but you need to start analyzing this company like an energy infrastructure play. The drop to $22.88 isn't about AI chip demand fading, it is about the market digesting the cost of capital required to build the physical backbone of the Internet's next phase. Most retail traders using SoFi Invest or Robinhood stock trading app look at the PE ratio or the revenue growth, but the smart money, the institutions utilizing Fidelity Wealth Management Services, is looking at the debt structure. The reality is that APLD has secured the financing to build what others can only promise, and that disconnect between the AI hype expectation and the industrial construction reality is where the opportunity lies. The contrarian take, why the debt matters. Let's challenge the common bearish argument right now. You'll hear people say they are taking on too much debt. Billions in notes at over 9% interest is dangerous. And sure, if you're running a lemonade stand, high-interest debt is bad. But in the world of heavy infrastructure, debt is fuel. When you see APLD successfully pricing $2.35 billion in notes, you shouldn't see risk primarily, you should see validation. Lenders do not throw that kind of capital at a company unless the underlying assets, the data centers, have guaranteed cash flows attached to them. This connects directly to the massive lease agreements APLD has signed, including that $5 billion deal with a U.S.-based investment-grade hyperscaler we heard about in October. The contrarian take here is that the debt isn't a weight, it is a bridge. It bridges the gap between the raw dirt in North Dakota and the revenue-generating AI factories of the future. While the retail crowd on Schwab Intelligent Portfolios might be scared off by the leverage, the bond market has effectively stamped approved on APLD's business model. That is a massive signal that often gets lost in the noise of daily stock price fluctuations. Deep dive, analyzing the recent movement. Let's zoom in on the price action we have seen over the last few weeks leading up to this $22.88 level. The stock has been volatile, oscillating between the low 20s and high 20s. This volatility is characteristic of a stock that is transitioning its shareholder base. A year ago, this was a favorite of the quick flip crowd. Now, as the market cap stabilizes around the $6.4 billion mark, we are seeing institutional accumulation. When you look at the volume profiles, the buying pressure on dips has been substantial. Every time APLD approaches $20, it gets bid up. Why? Because the AI trade is shifting from the chip makers to the power providers. We saw NVIDIA report earnings recently, and while the numbers were stellar, the stock reaction was muted. This tells us that the easy money in the hardware producers has been made. Capital is now rotating into the derivatives of that trade, the companies that house and power the chips. APLD sits squarely in that lane. The slight decline today is likely due to some profit-taking from traders who bought the dip last week, combined with broader macro anxiety about interest rates. Since APLD is now a heavy borrower, any tick up in Treasury yields makes their future refinancing look more expensive, putting temporary pressure on the stock. However, the fundamental demand for what they sell, data center capacity, is inelastic right now. Whether rates are 4% or 5%, the hyperscalers need a place to put their H100s and Blackwell chips, the NVIDIA connection, and sector momentum. We cannot discuss Applied Digital without addressing the elephant in the room, NVIDIA. The correlation between NVIDIA stock and APLD is high, but it's decoupling in a healthy way. Previously, APLD would move in lockstep with NVDA. If NVDA sneezed, APLD caught a cold. Now we are seeing APLD stand on its own merits. This is partly because of the direct investment relationship. Remember, NVIDIA is not just a customer ecosystem partner. They have participated in financing rounds. This seal of approval is crucial for investors using online investment platforms who might be hesitant to back a smaller player. Knowing that the king of AI has skin in the game provides a psychological floor for the stock. Furthermore, when we look at the broader sector, other infrastructure names like Vertiv or even utilities like Vistra Energy have been rallying. The market is waking up to the power shortage thesis. AI consumes electricity at a ravenous pace. Applied Digital's strategic advantage is its ability to secure power in places like North Dakota, where the grid isn't as constrained as it is in Northern Virginia. This geographic arbitrage is a key value driver. When you are conducting self-investing research, always look for the bottleneck. The bottleneck in 2023 was chips. The bottleneck in 2025 is power and space. APLD solves for the latter. Macroeconomic pressures and institutional flows. The macroeconomic environment is currently a mixed bag for growth stocks. On one hand, the economy is holding up, which supports the soft landing narrative. On the other hand, inflation fears haven't completely vanished, keeping the Fed cautious. For a company like Applied Digital, the macro picture is secondary to the sectoral tailwinds. But we must pay attention to institutional flows. Recent 13F filings indicate that major asset managers are increasing their exposure to digital infrastructure. If you look at the holdings within Fidelity ETFs or Fidelity mutual funds that focus on technology or small-cap growth, you will likely see APLD creeping up the weightings list. This institutional support dampens the downside volatility. Unlike a retail-dominated stock that can drop 20% on a rumor, the institutional ownership here provides a buffer. They're in this for the multi-year build-out, not the intraday scalp. The $22.88 price tag today might look expensive compared to the $3 lows of the past, but if you run a discounted cash flow model based on their signed leases, many analysts argue it's still undervalued. The disconnect comes from the execution risk. Can they build the data centers fast enough? That's the billion-dollar question. Business model, more than just a landlord. To truly understand the value proposition here, we need to clarify what Applied Digital actually does, because there's a lot of confusion among those new to online investing. They are not just a landlord renting out empty warehouses. They are a next-generation data center operator designed specifically for high-performance computing. Traditional data centers were built for the internet era, storing